Welcome to our March quarter update. It was certainly an interesting quarter, both from a market perspective and also we've recently just completed a client and advisor roadshow where we gave an update on our long-term thinking, which is really an extension of what we first alluded to back in 2017 with our Moneyball presentation, where we gave an insight into our investment philosophy and process. And this time we're really looking outward in terms of where the risk reward is sitting today, and particularly some of the risk factors like bonds, bond proxies, infrastructure and the consumer sector. So for those clients that weren't able to see the presentation, I'd really encourage you to look at it on the website in addition to the original Moneyball presentation, because I do think it gives a very good framework for what we believe we'll be dealing with going down the track. Now in terms of markets, obviously a little bit more volatile this quarter. Point to point, not much action, but a lot of action in between. One of the most common questions we got on the roadshow was about tariffs and the risk that they would bring to the economy. Now the reality is, if we have a trade war, we know it's not going to be good for markets. I think though that investors need to look at the real issue longer term, stay away from the noise, Trump's kind of comments on tariffs and China biting back. But the real issue is that the US has been running with a trade deficit for 20 plus years. If you think about it, the United States of America rebuilt Asia, Korea, Japan, China, Taiwan, all on the back of their consumption, which was a trade deficit in the US and trade surpluses in Asia. So Trump's basically saying enough's enough and we need to deal with this problem, and they do need to deal with that problem. And that's why you're getting all the headlines and the initial tariffs. It's really a ploy to bring everyone to the negotiation table and deal with an issue that needs to be dealt with. So I'm not sure how it's going to play out. It's always too hard to really come to a firm conclusion on macro and political, and that's why we say avoid it, don't worry about it, focus on the stocks. And in terms of the stocks, the reality is valuation still looks very reasonable. Now having said that, what you saw during the quarter was really the first signs of liquidity coming out of the system. It's what we referred to as Bondnado 2. Market scares are now going to be very much on the back of inflation, and that's what you've seen. And we're going to have more of them along the way because the underlying economy is a lot tighter than people realise. But if we go back to valuation, with the minor pullback that we have had in the markets, banks are selling on 10 times again, which is as cheap as they've been in many, many years. Our alternative investment managers are selling on 10 times or less, and our home building stocks are selling on between 8 and 9 times. So I'm not too worried about valuation, and the real issue going forward is, can they grow their earnings and can the market grow their earnings? And so far that looks as though the answer is yes, and as a result we're continuing to commit to our investments. We still think they'll earn a satisfactory rate of return, but we have noted that the risk reward has changed, and that's why we believe going forward that a maximum 85 to 95% invested position is what we want to deal with. You do need to be more conservative. You don't want to be leveraged, but we still think we can make an acceptable rate of return. In terms of some of the stock news during the quarter, the one that probably stands out the most is Hispania. It's a property investment in Spain. It was an extension of the Las Vegas real estate story, where we found the same sort of situation in both Ireland and Spain. And the reason we invested in Hispania was not only because of the attractive outlook for property assets in Spain, but also because when we visited with management, they were very much aligned with our way of thinking in terms of the sort of risk-reward equation that they were looking for. And during the week, they actually received a takeover bid from Blackstone. So that investment looks like it will now be exiting the portfolio. Also of note, our housing investments, recent results from the housing companies have been very, very strong. Lennar recently released their results and the stock was up 10% on the back of very strong results. So we think they continue to be an attractive investment. And also, we would have previously alluded to the fact that we believe there was a pricing anomaly in our alternative investment managers. And the catalyst for releasing that would be with tax reform converting to the standard corporate structure from a trust structure. And during the quarter, that's exactly what happened with Ares, one of our investments. They announced the conversion to a corporate structure. And as a result of that, the stock was up 20 to 25%. So I guess in summary, markets are going to be a little bit more difficult going forward. You need to be very focused. The risk reward has changed. You need to run with more conservative positions. But I guess the good news is that, and I'm going to point to some research from Bank of America Merrill Lynch that we recently came across, which basically highlights that although short-term valuation discrepancies are becoming fewer in nature, that when you look out longer term, the real long-term alpha opportunities are increasing demonstrably. And so I think that's hopefully good news for stock pickers. And that's really the sort of market that we're going to be faced with going forward. It's back to the old days of a genuine stock pickers market. So with that, I'm going to wrap up, but we will follow up with further market insights over the next month or so because, given what's happened over the quarter, there is a lot to talk about. So thank you for your time.